So whether you're trying to buy a house or whether you're trying to sell a house, there's going to be offers involved. And a lot of people think offers look like this. I offer you $1 million for this house. But in reality, an offer is a lot more than that. And a lot of the mechanics of an offer can make a big difference, either for you or for the person you're trying to work with in doing this transaction. And today I want to break that down for you. Now is a good time to remind you that I'm a real estate agent in Buffalo, New York, and all of Western New York. So there are going to be some things that are universally true for everywhere, and there are going to be some things that are specific to this market. I'll do my best to point those out. But if you are not playing in this market, not all of this is going to apply to you. So what I'm going to do is I'm going to go through each, kind of define each of the parts of an offer. And if you just want to skip ahead to the part where we compare offers next to each other, we'll put a little timestamp on the screen here. You can just skip forward to that, but let's jump into it. So starting first with the money. Cash transactions happen. We're going to get into that in a little bit, but I would say the majority of the time real estate is transacted with some sort of loan, most commonly referred to as a mortgage. There are all types of mortgages out there, and we're going to cover some of the more common ones, but cash is cash. We'll get that out of the way for now. Perhaps the most important part of an offer is the price. And the first thing we need to know is how much is the offer, and a close second is it all cash or are they going to be getting a mortgage? And if they're getting a mortgage, the four things we're concerned about are how much are they putting down, what type of loan product is it, how quickly can they have mortgage commitment, and who's the bank running the show. So some quick notes on all of those. In this world and in the contract, we use the term loan to value. So if somebody's putting 10% down, it's a 90% loan to value. There are three main types of mortgage products: conventional, FHA, and VA. They have their differences. Conventional is going to be the smoothest way to transact them. FHA and VA can come with different clauses and often require more repairs than a conventional. Here in Western New York, the contract defaults to 45 days to provide mortgage commitment. I would say I've seen more 30 days than 45 days as of lately, but that is going to be a critical day in the contract. We're going to want to know when and how quickly we can get that mortgage commitment from the bank, and who the bank is, of course. The key thing in that is if somebody makes an offer on a house with a pre-qualification letter from a certain bank, they're going to have a certain amount of time to apply for the mortgage. And if they choose to apply for the mortgage with a different bank, they can. They can make their loan product better for the seller, but they can't make it worse. So if somebody said they were going to do a 90% down conventional and they were going to get it through premium mortgage, and they decided they wanted to work with M&T, they can do that. If they wanted to do 95% loan to value, they would have to get permission first. That would be putting less money down. But if they wanted to put more money down with a lower loan to value, they can do that without asking permission. So that's that with mortgage and price. Sometimes buyers need what are called seller concessions, which is just a fancy way to say that they need to borrow some of their closing costs. This is important because if somebody wants to make a $260,000 offer, but they need seller concessions, what that means is to make a $260,000 purchase, they need a certain amount of cash and they don't have it. So they're going to wrap part of that into their mortgage. So if somebody wanted to make a $260,000 offer and they wanted to use $15,000 worth of seller concessions, the total sale price is going to be $275,000. The seller is actually going to receive $260,000 before their cost of sale. The property needs to appraise for the entire $275,000, which on paper would mean that the house is worth $275 and the seller is taking $260 for it. And the extra money that house is worth, the buyer is capturing by way of borrowing toward their closing costs. So there is an argument to be made that anytime a deal has seller concessions, the seller is leaving money on the table. If the best offer on the table includes seller concessions, it may be true that you could one day get more money for it, but if you're trying to decide if you should take this good offer right now, that is what seller concessions means. Next, we're going to talk about deposit. Here in Western New York, we call it earnest money deposit, or EMD. This is separate from your down payment. When you place a deposit, it's going to count towards your total cash to close. It's going to be held in an escrow account by the listing agency or the seller's attorney in the meantime. And this is if you come to an agreement to buy a house and you place the deposit and then you just go decide to buy another house, your deposit's probably at risk. I've seen deposits range from $500 to $100,000 or more. And I would say most commonly we see $5,000, $10,000, and $20,000. So if you're a seller, the higher the better. If you're a buyer, if you know your total cash to close is $25,000 and you're deciding between making a $5,000 deposit and a $10,000 deposit, I would suggest doing the $10,000 deposit. It makes your offer stronger. Obviously, you have a little bit more skin in the game, which is why it makes your offer stronger. And that is money that you're going to be bringing to the closing table anyway. So that's if you're a buyer, that's one of those small things that you can do to make a big impact in a competitive situation. If you're a seller, you're going to want to see as much money of a deposit as you can. You can also ask for more. If somebody were to make an offer for $300,000 with a $5,000 deposit and you said, hey, we like everything about this deal, but we'd really like to see $10,000 from you, that is a perfectly reasonable thing to ask for in a counteroffer. That's deposit. Moving on to home inspections. So, home inspections are, contrary to popular belief, not a pass-fail thing. A home inspection is what's called a contingency. And we're going to talk a lot about contingencies today, but if you make an offer on a house, or if you're selling a house and a buyer makes an offer that includes a home inspection contingency, in the contract, they're going to tell you how much time they're going to do it in. The contract defaults to 5 days. I like to do them in 2 days or less. And that's going to be the key thing in the contract / offer that you're going to be looking out for. So if a buyer does a home inspection and everything comes back peachy, but they don't want to buy, because it's a contingency, they don't have to provide any reason. They can just say, we did a home inspection. We no longer choose to proceed. Here's your release. There's a lot of strategy as a seller in how you're going to handle those days that the home inspection is going on, by way of how you're advertising it, what its status is in the ML, all that fun stuff. But if you're a buyer, you want to do that home inspection as quickly as possible, still giving yourself enough time to think clearly through that whole process. But the faster you can clear that contingency, the happier the seller is going to be. If you are a seller, you want to see as short of a window here as possible and understand that even if you have a perfect house, which I've never seen before, the buyer can still bail. When you're looking at an offer, or you're making an offer, there's going to be a contract closing date in the contract. And that is not the day that this property is going to close. It might be, but we don't know that yet. A quick summary is that the contract closing date is the first opportunity to do what's called calling time is of the essence. So a finance deal here in Western New York takes about 2 months to close. And so that's when we put the contract date in, usually, in 60 days from the contract date. And if that contract date comes and nobody's ready to close, either side can call time is of the essence, and that gives the other side 7 business days to close the deal. And if either party doesn't show up, then the deposit is protected either way. So if the seller calls time, buyer doesn't show up, seller keeps the deposit. The buyer calls time, seller doesn't show up, buyer keeps the deposit. This is going to come down to everyone's personal situation. There are sellers that want to close quickly. There are sellers that need time to find their next house before they even know what the closing date on their current house looks like. 60 days is standard. 30 days is standard for a cash deal, but really it's going to come down to the attorneys and the title process, which is lengthy here in New York State. You go to Florida, you can buy a house in 2 weeks or less. There are ways here in Western New York that you can make the whole process go faster, and if that is what everybody, buyer and seller, are expecting for the transaction, that's where you would edit this. But we're clearly stating in the initial contract what the ideal closing date would be. That is not a concrete closing date. That's going to come from your attorney, usually 5-ish days prior to actual closing. Speaking of attorneys, a little talked about and highly important aspect of any offer is who the attorney is on each side. So here in New York State, in Western New York, generally each party, and if there is a mortgage, the bank is going to have their own representation, an attorney. Attorneys that transact real estate on a regular basis are good. The family attorney who happened to set up a will for somebody 15 years ago and you haven't talked to since, if they don't transact real estate regularly, is going to make this process a disaster. New York has a very specific title process and closing process, and having an incompetent attorney on your side or the other side is going to create a lot of headache. In the contract, they're going to say there's an opportunity for each attorney to be stated, and you're going to want to have as much control over that as possible. Your real estate agent should be able to refer you at least 3 very good, reasonably priced real estate attorneys. And if you choose to go off on your own, please know the risks of that. But if you're making an offer or you're selling a house, once an offer is agreed upon, the whole deal is a lot more in the hands of the bank and the attorneys than it is in the real estate agents at that point and for the remainder of the closing. Have a good attorney. And if you want to make your offer stronger, or if you want to, as a seller, if you want to get a leg up on how smooth this deal is going to go, you're going to want to advertise who your attorney is going to be, and you're going to want it to be a reputable one. Another quick note on an attorney. I'd mentioned that the title process and closing process in New York State takes a while. There are some attorneys that can speed that process up quite a bit. You pay for that, but if you find yourself in need of needing to buy or sell property quickly, there are attorneys that specialize in that, and I'm happy to connect them with you. And finally, contingencies. Most commonly, sale contingencies or closing contingencies. So a sale contingency means I would like to buy this house, but I have to sell my house first. A closing contingency means I would like to buy this house. I have already come to an agreement to sell my current house. I just need that to close in order to actually close on this house that I'm trying to buy. Going forward, anything that you see with red tape on it is going to be a contingency. But contingencies also get their own tile, because if it's sale or closing contingent, it's going to be a contingency throughout the entire process, where a lot of these contingencies over here are going to be cleared throughout the process. So that was a lot of information. Let's see what it all actually means. So what I have in front of me are 2 different offers, and they're largely similar. They're both $200,000. They both have a $10,000 deposit. Neither of them has a home inspection, and they both have reputable attorneys to do the deal. The key difference being this one's all cash, this one's getting a mortgage. And you've probably heard that cash is king, but these are some primary reasons why. Anything with red tape on it is a contingency. So this has a financing contingency as any deal with a mortgage will. Presuming everything's peaches and roses up to offer time, buyer has a good job, they've been there a long time, what have you. Heaven forbid, halfway through, this offer gets selected, halfway through the closing process, this buyer loses their job for some reason. They no longer satisfy the financing contingency, and therefore can back out, can keep their deposit. Whereas with cash, when you make a cash offer like this, you're saying, I have the cash, there is no contingency around that. So when closing day comes, I have it, we don't have to appraise, it doesn't matter. I'm putting 100% down, so it doesn't matter what it appraises for at all. There is no mortgage commitment to get, nothing like that. So that's what anytime you see red tape on these things, it complicates the deal. The less red we can have, the cleaner the deal is. Talking about seller concessions now. So again, 2 offers that look very similar with one key difference. Each party's doing a home inspection, the deposits are the same, we have good attorneys. Getting down to the money. So in this example, offer 1 is offering $210,000, offer 2 is offering $200,000. Offer 1 has $15,000 worth of seller concessions. So while the total purchase price here is more, a seller would net more money by taking this offer, because you have to subtract the $15,000 seller concession from the $210,000 total purchase price. So the seller would net $195,000, where they would net $200,000 here. Sometimes you'll see what are called escalation clauses. A seller can decide whether they'll entertain these or not. Even if the seller says no, the buyer can write any kind of offer they want. But the way an escalation clause works is to say, so we have the same 2 offers here, one's $210,000, one's $200,000. We're eliminating the seller concessions this time. So at the moment, offer number 1 here at $210,000 is the higher bid. If the $200,000 offer put an escalation clause, that would say, we offer $200,000, we will beat any offer that you can show us by $5,000 up to $225,000. And if this was the only other offer on the table, then the seller would say, here's our $210,000 offer, so it would be yours at $215,000. So we would just swap this right out for 215. And I've seen people handle that any number of ways. I can honestly see both arguments for and against. I've had sellers say if somebody's willing to pay a certain price, but they're willing to pay more, if somebody else is, that's a good thing for me as the seller. Sure. I've had other sellers tell me if somebody's willing to make that high of an offer, they should do that regardless of what other offers come in. Also true. When it came around a couple of years ago, it was very popular. These days, it's kind of contested. I don't like it for sellers. I do like them for buyers. So, how often have you seen a house sell for cash and wondered to yourself, where's all this cash coming from? So, it's rare that a buyer saves up $250,000 and then goes and starts their home shopping. There are ways that you could borrow against the equity in your current house. There are, if you're talking investment property, I know lots of investors that started relatively small, bought a few doubles, drew off the equity of those to buy a complete another investment property in cash. Once that closes, they turn around and go get another mortgage, get a mortgage, so that they're reimbursed all that cash. That stuff goes on. I have seen first-time home buyers pay entirely cash by either borrowing from their 401k or borrowing from somebody that they know, parents, grandparents, you name it. Sometimes the elder people in the family have cash that they can be away from for 6 months. And that gets a little dangerous because if you make an all-cash offer without a financing contingency, you are obligated to buy that house regardless. You pay $300 for a house in cash, you go to the bank and they say this is only worth $285, we can only loan $285. That difference is going to have to be made up with that cash. So make sure whoever you're borrowing that money from is okay with that gap difference. A question that I'm asked often is, will we be getting a counteroffer? And any answer to that question you could think of, I have for you. So do I see counteroffers? Yes. Is there any rhyme or reason to them? Often not. So a seller is free to do as they choose. If they get 12 offers and don't want to take any of them, they can do that. If they get 12 offers and they want to counteroffer some of them but not all of them, they can do that. It's very hard to predict as a buyer if you're going to get that phone call. And the best advice I have for you there is to, based on your interest in the house. I've sold houses to people that said, yep, we like this house at this price. If that's where you're at, great. If you get that counter offer and you bump up a little bit just to get it done, sure. If you are already making the type of offer that's like, we're throwing everything we have at this, you would almost be afraid of a counter offer at that point because you're putting everything you have at it. And if they're asking you for more and you can't bridge that gap, heartbreaking as it is, what you're hoping for in that situation is that either there is no competition, or if there is competition, the seller is not calling and counter offering people. I've seen it play out every single way. So, will we get a counteroffer? Solid maybe. And finally, offers are done here in Western New York on the same 13-page sale contract, and there's attachments and addendums and what have you, but we as real estate agents fill in the blanks. A competent real estate agent can fill out that contract in 5 minutes or less. If you are making offers and you're not winning, and you haven't signed anything, either ink sign or electronically, what's probably happening there is your agent is making verbal offers, and I have opinions on verbal offers. So there is a time and place for them, no doubt about that. I have made verbal offers, I have gotten verbal offers accepted, and then we fill out the contract. Time and place for that. Yesterday, house I listed in Cheektowaga, I had 2 separate agents lowball the hell out of us by way of filling out some of these critical information in the text message and not actually providing us a contract. We're getting a little bit more into human psychology than we are real estate transaction at this point, but there is something that happens when a offer is put on paper, signed and dated in front of a seller. It's just more serious. And so, again, like I was talking about just a moment ago, if you're like, I would buy this house at this price, but I'm not like super gung-ho about it, I'm gonna lowball them. Yeah, a verbal offer might save some people some time and stuff like that. But as time goes on, I see all kinds of real estate agents running around and they're doing their buyer clients a disservice by not appearing as serious in the offer as they could be. So just be on the lookout for that. If you're making an offer and you're signing something, it's a written offer being submitted. If you're making an offer and that is not happening, I would ask them if the offer is on a contract and being submitted formally. If you're a seller and an offer's put in front of you on paper as a signed contract, there's still going to be a few days, like attorney approvals the first 3 business days. Anybody can cancel for any reason at all, including no reason. There's going to be some guesswork between signing that contract and getting the deposit, and then another 2 months or so before closing. If you're verbally hammering out an offer before you see that contract, the risk of things going sour increase dramatically. So just be prepared for that. And if you're a real estate agent out there, take 5 minutes to fill out the contract, please. So why am I even making this video? So if you're in the market, I think there's a lot of confusion out there at how this all actually works versus what the public sees on the, selling sunset and all that fun stuff. I'm not dogging selling sunset. I'm just saying that the way that this all comes together is often more complicated than people realize or even know to ask about. And if you're a buyer, I want you to know that there are ways aside from money to put your best foot forward. And if you're a seller, I want you to know that there's things to be on the lookout for, and the key things that can make massive differences in what is likely a very large transaction in your life. When people start seeking out a real estate agent at no fault of their own, they often don't even know what they're looking for. And these are some guidelines to ask about, with your real estate agent. These are some things to be thinking about while you are mentally preparing to be selling or buying a house. And I also wanted to tell you those things so that if you need a real estate agent, I'm here for you. My email address is in the description below. You can find me on all the major social media sites at Johnny Sells Houses, JOHNNY, and I'd love to help you out.